In fact, let's continue that conversation going forward. And we have with us Pankaj Tibrewal as well, who's joining in. Pankaj, trying every way to sort of dissect how one should be reading into the global jitters that have spooked our markets. Would you concur with the advice that we've been getting in from some of our other market experts that as of now, there is no need to panic and there are opportunities, but don't be in a bit of a rush?
Absolutely. I think the longer term view clearly remains positive. But what we have been concerned about is the near term valuation. And on the hindsight, the reasons come to know. Look at what has happened in Japan, for example. 20% correction in just few days' time. And whatever you generated in the last 8 months in this calendar year has been wiped off in few days. Um, Similarly, in India, we see certain pockets of exuberance. We believe this is the market where we need to be absolutely sure what not to invest in. And clearly, there are pockets where you need to avoid. Otherwise, it could lead to permanent loss of capital. For example, when I look at the entire defense and railway space, uh, the total market cap now is about 18 lakh crores. FY19, this market cap combined was 1.2 lakh crores. So we have seen a CAGR of 70% approximately on market cap. Whereas when we look at the earnings, it's compounded at about 21%. So clearly the multiples have expanded and a lot of money chasing few little stocks and free floats. So clearly we need to be careful in the way we approach the markets. Our belief is the easy money is behind us and markets are incrementally going to be stock specific. The breadth of the market has started to narrow down substantially. And we believe that this is the time where you need to be a risk manager rather than a fund manager.
Quite interesting, Pankaj. So curious to know what is it that you would recommend buying into once, of course, the dust settles down?
So, Aisha, clearly there are certain pockets which probably are showing signs of recovery. One is the consumption basket. And we believe that the last 3, 4 years we have seen pain, especially on the mass consumption side. We are starting to see some improvement out there. And the first quarter numbers in many consumption names show that the volume growth has started to pick up, which is encouraging. The second space is pharma. We believe that the results which came out till date from the pharma companies have been quite encouraging, both on the domestic side as well as the US generic side. And valuations continue to remain favorable on that sector. Third is the private sector financials. We believe that they have not participated in the rally in the last 2.5, 3 years. And some of the select private sector financials look to be decent in terms of overall things. Fourth is the entire auto ancillary space. And we believe some of the auto ancillaries are pivoting themselves from pure auto to industrials also. And the outlook for them seems to be quite good. Last but not the least, we are bullish on manufacturing and the power theme, but valuations at the current junctures continue to remain challenging. We would wait for opportunities in this correction to have exposure to few of them. So I think that this will be probably the basket which we will be looking at from an overall perspective. And don't forget, Aisha, finally stocks are slave of earnings. Last year, we saw earnings growth in Nifty 500 companies at about 30%. Our view is that the slowdown is quite substantial. In the first quarter, till date, halfway through, 300 companies have reported out of the Nifty 500 companies, and the earnings growth is just 3% on a headline basis. And if we dissect it into two parts, out of these 300 companies, 71 companies are banking and financial companies, which have grown their earnings of more than 21%. But the 229 companies are non-banking and financial services company, where the earnings degrowth has been 11%. So clearly the non-banking part is been seeing the pain. And we believe that the margin levers, which was the main portion of earnings growth last year, is absent this year. And probably the next couple of quarters, the earnings growth could be subdued. On an overall year basis, we are looking at a 10 to 12% earnings growth, for Nifty 500 companies, which is much, much lower than the last year's 30% earnings growth. And hence our belief is that the market breadth will narrow down. It will be more stock specific rather than the market being charitable to everybody last year.
Really appreciate your time. It's just been, you've been running from pillar to post, airport to office. You managed on time. Thank you very much for that.